The IRS is coming for your Social Security lump sum. You have days to stop it. Something just happened that's going to blindside millions of retirees, and almost nobody is talking about it. Congress passed a law to give you back money you were owed, benefits that were stolen from you, legally, for decades. In 2025, 3.1 million retired teachers, firefighters, police officers, and public servants received lump sum checks averaging $6,710 per person. That's $17 billion in total. Money the government owed you, finally paid. And now, the IRS wants a cut. Not because you did anything wrong, not because you cheated the system, but because of a timing rule buried in the tax code. A rule that turns a decades-old correction into a single-year income spike. And that income spike is about to push millions of retirees into a tax bracket they've never been in. Trigger taxation on Social Security benefits that were previously untaxed.
And in some cases, increase your Medicare premiums for the next 12 months. The deadline to deal with this is April 15th. That's 13 days from today. And the IRS is not going to call you to explain what's happening. Your tax software probably won't catch it. Your accountant might not even know about it. But by the end of this piece, you will know exactly what to do. And if you act fast, you could save yourself thousands of dollars. Let's start from the beginning, because if you don't understand the history, you won't understand the trap. The 40-year injustice that led to this moment. For over 40 years, two provisions in the Social Security system penalized public sector workers: the windfall elimination provision, known as WEAP, and the government pension offset, known as GPO. If you worked a job that didn't pay into Social Security, like teaching in certain states, serving as a firefighter, or working for a federal agency under the old civil service retirement system, these provisions reduced or completely eliminated your Social Security benefits, even if you had paid into Social Security at other jobs for years. Even if your spouse had earned full benefits that you should have been entitled to as a survivor. The math was brutal. Some retirees lost hundreds of dollars a month. Some lost their entire benefit. Widows of public servants who expected to receive survivor benefits got nothing. It affected over 3.2 million Americans. For decades, they fought to change it. Advocacy groups rallied. Lawmakers introduced bills. Retirees testified before Congress. And finally, on January 5, 2025, Congress passed the Social Security Fairness Act. It eliminated WEP and GPO entirely, and it made the fix retroactive to January 2024. That meant every affected retiree was owed back payments for every month since January 2024, when their benefits should have been higher. The Social Security Administration moved fast. By July 2025, they had processed over 3.1 million payments totaling $17 billion. The average lump sum payment was approximately $6,710. Some people received more, some received less, but for millions of retirees who had been shortchanged for years, it felt like justice. And then the tax bill came. Now, here's where the trap closes. Under current IRS rules, Social Security benefits, including retroactive payments, are taxable in the year they are received, not the year they were earned, not spread out over the years they should have been paid, taxed in full in the single year the check arrived. That means if you received a $6,710 lump sum in 2025, the IRS treats that as $6,710 in additional Social Security income for tax year 2025. It hits your return right now, the one due April 15th. And for most retirees, that spike doesn't just add to your income. It triggers a cascade. Let me show you exactly how this plays out. There's 4 real scenarios, and what happens to your tax bill. I want to walk you through 4 real situations so you can see the math. Scenario 1. A retired teacher in Ohio. She's 68 years old. She receives $22,000 a year in Social Security and $18,000 from her state pension. Her provisional income, that's her adjusted gross income plus tax-exempt interest, plus half of her Social Security, was sitting at about $31,000. That put her in the 50% zone, meaning half of her Social Security was taxable. Uncomfortable, but manageable. Then the lump sum arrived. $7,200 in retroactive benefits. Half of that, $3,600, gets added to her provisional income. She jumps from $31,000 to $34,600. She just crossed the $34,000 threshold. Now up to 85% of her Social Security is taxable. Not 50%, 85%. The difference in her tax bill is somewhere between $2,000 and $3,000 in additional federal taxes. On money Congress said she was owed. On money she probably already spent on medical bills and groceries. Nobody warned her. Scenario 2. A retired firefighter couple in California. Both spouses are former public safety workers. Both were affected by WEP. Combined lump sum, $14,000. They filed jointly. The income spike doesn't just push more of their Social Security into the 85% taxable zone. It pushes their modified adjusted gross income above the IRMAA threshold. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a surcharge the government adds to your Medicare Part B and Part D premiums when your income exceeds certain levels. The surcharge is based on your tax return from 2 years prior. That $14,000 lump sum received in 2025 will affect their Medicare premiums in 2027. They could pay an extra $70 to $240 per month per person in Medicare surcharges for 12 straight months. Not because their actual financial situation changed, because of a one-time retroactive payment that inflated 1 year of income. They're being penalized for receiving money they were owed. Dava Werner. Scenario 3. A 72-year-old widow. Her husband was a state employee. After he passed, she applied for survivor benefits. Under the old GPO rules, those benefits were eliminated entirely. She received nothing. The Social Security Fairness Act restored her survivor benefit and sent her a retroactive lump sum payment. But she files as single. The thresholds for single filers are lower. $25,000 for the 50% zone. $34,000 for the 85% zone. The lump sum pushed her over both thresholds in 1 year. She went from zero Social Security taxation to 85% taxable in one filing. She's now grieving, navigating a new filing status as a single person, dealing with the widow's tax penalty that comes from losing the joint filing threshold, and sitting on a surprise tax bill that nobody at the Social Security office mentioned when they sent her the check. Scenario 4. A retired police officer who already filed. He did his return in February, used a standard tax preparation service. He saw his refund was smaller than expected, paid his bill, and moved on. He didn't know about the lump sum election. He didn't know about the $6,000 senior bonus deduction. He left approximately $2,500 to $4,000 on the table. I'm going to explain both of those in a moment, because they are the two things that can fix this. But I want you to understand first what the common mistake is, because almost everyone is making it. Say, the mistake. Almost everyone is making. The mistake is this: filing your 2025 return normally, seeing a higher tax bill than expected, assuming that's just how it works, paying it, and moving on, without knowing that the tax code gives you a tool to recalculate that lump sum payment, without knowing that Congress quietly created a brand new deduction for seniors that most tax software isn't applying automatically. If you received a lump sum payment under the Social Security Fairness Act and you filed your taxes without using these two tools, you almost certainly overpaid, and you have 3 years to fix it. Let me show you how. Tool number 1, the lump sum election. The IRS allows you to choose how you report a lump sum Social Security payment. You have 2 options. Option 1. You include the entire lump sum as income in the year you received it. That's the default. That's what happens if you or your tax preparer do nothing special. The full amount hits your 2025 return and inflates your provisional income. Option 2. You use the lump sum election. This lets you go back and recalculate the taxable portion of your Social Security benefits for the prior year, 2024, as if the retroactive benefits had been received when they should have been. You figure out how much of those benefits would have been taxable in the prior year. Subtract that from the current year amount, and only report the difference on your 2025 return. The instructions are in IRS Publication 91 You compare the tax under both methods and use whichever produces the lower tax. You don't need to file an amended return for the prior year. The recalculation happens entirely on your 2025 return. For many retirees, especially those whose lump sum pushed them across a provisional income threshold, the lump sum election can save hundreds or even thousands of dollars. It's the difference between 50% of your benefits being taxable and 85%. Ask your tax preparer this exact question. Did you calculate the lump sum election for my Social Security Fairness Act payment? If they don't know what you're talking about, find someone who does. Tool number 2, the $6,000 senior bonus deduction. This one is brand new, and it's the reason I need every senior reading this to pay attention. The One Big Beautiful Bill, signed into law on July 4, 2025, created a new deduction specifically for taxpayers 65 and older. It's $6,000 per qualifying person. If you're married filing jointly and both spouses are 65 or over, that's $12,000. This is separate from the existing Senior Additional Standard deduction. This is on top of that. It didn't exist before 2025. It was specifically designed to reduce the taxable portion of Social Security benefits for retirees. The income limits for the full deduction are $75,000 for single filers, $150,000 for married filing jointly. Above those limits, it phases out. Below them, full benefit. This deduction is available right now for your 2025 return. It's claimed on the new Schedule 1A. But here's what I need you to hear. Not all tax preparation software is flagging this deduction automatically. It's brand new. It was buried in a 100-page bill. Some programs haven't been updated. Some tax preparers haven't caught up. You might have to look for it yourself. Ask your preparer specifically. Did you apply the senior bonus deduction from the One Big Beautiful Bill? If they give you a blank stare, that's your answer. For a single filer in the 22% bracket, that $6,000 deduction saves $1,320. For a married couple, the $12,000 saves $2,640. Combined with the lump sum election, you could be looking at $3,000 to $4,000 in savings. On money, that's yours. What about the bill to fix this entirely? I know some of you have heard that Congress introduced a bill to fix this entirely. The No Tax on Restored Benefits Act was introduced in February 2026. It would create a one-time exclusion for the retroactive lump sum payments, meaning you would owe zero tax on the money. The bill has bipartisan support. It's in the House Ways and Means Committee. It has not passed as of today, April 2, 2026. It's not law. Do not wait for it. Do not assume it will pass before your filing deadline. If it passes later, you can file an amended return and get the money back. But if you miss the April 15th deadline hoping Congress will save you, and they don't, you'll owe penalties and interest on top of the tax you already owe. File now. File correctly. Amend later if the law changes. Your action checklist: 7 things you need to do right now. Here's what you need to do, step by step. 1. Pull your SSA 1099. If you received a lump sum payment under the Social Security Fairness Act in 2025, the total amount is on your SSA 1099 form. If you don't have it, log into My Social Security and download it. Note the total. That's the number driving your tax situation this year. That's your 2. Calculate your provisional income. Add your adjusted gross income, your tax-exempt interest, and half of your total Social Security benefits, including the lump sum. If you're over $25,000 as a single filer or $32,000 married filing jointly, your benefits are being taxed. If you're over $34,000 single or $44,000 joint, up to 85% is taxable. Duraces 3. Run the lump sum election calculation. Open IRS publication 915. Follow the worksheet for the lump sum election. Compare Method 1 and Method 2. Use whichever produces the lower tax. This alone can save you $1,000 or more if the lump sum pushed you across the threshold. Hour 4. Claim the $6,000 senior bonus deduction. If you're 65 or older with modified adjusted gross income under $75,000 single or $150,000 joint, you qualify. It goes on the new Schedule 1A. Make sure it's on your return. Tiarwa 5. If you already filed without these, file an amended return use form 1040X. You have 3 years. Don't leave this money sitting with the IRS. Dosira Kiuki 6. Check for IRMA impact. If your 2025 income, including the lump sum, pushed your modified adjusted gross income above $106,000 single or $212,000 joint, you may face Medicare premium surcharges in 2027. You can appeal by filing a life-changing event form, SSA 44, with the Social Security Administration if you can show the income spike was a one-time event. This is not automatic. You have to request it. 7. Plan for next year. The Fairness Act didn't just give you a lump sum. It permanently increased your monthly Social Security benefit. That higher monthly amount will affect your provisional income every year going forward. If you were near a threshold before, you may now be above it permanently. Talk to a tax advisor about Roth conversions, qualified charitable distributions, adjusting your withholding to avoid a surprise next April. Waikiro. Why this matters more than you think. I want to be direct about something. The Social Security Fairness Act was the right law. Those benefits should never have been taken in the first place. But Congress passed the fix without addressing the tax consequences. They knew lump sum payments would create income spikes. They knew those spikes would push retirees into higher tax brackets. They introduced a bill to fix it. That bill is still sitting in committee. While 3.1 million retirees file their taxes, the IRS won't call you. Your tax software might not catch it. Your preparer might not know about it. That's why this information exists. The real cost of doing nothing. Let's be clear about what's at stake. If you do nothing, you could owe an extra $2,000 to $3,000 in federal taxes. You could trigger Medicare premium surcharges that cost you $1,000 to $3,000 in 2027. You could miss out on a $6,000 deduction that was created specifically for you. And you could leave all of that money on the table forever because you didn't know it was an option. But if you act, you use the lump sum election to spread the tax impact. You claim the senior bonus deduction. You file correctly. You save thousands. And if Congress eventually passes the bill to exempt these payments entirely, you file an amended return and get every penny back. That's the difference between being informed and being caught off guard. Treachery. What happens if you miss the deadline? If you don't file by April 15th, the IRS will assess penalties and interest. The failure to file penalty is 5% of the unpaid taxes for each month you're late, up to 25%. The failure to pay penalty is 0.5% per month. Interest accrues daily. If you owe $3,000 and you're 3 months late, you could owe an extra $500 or more. And none of that includes the tax you already owe. Don't let that happen. File on time. File correctly. Final thoughts. Congress gave you back money you were owed. That was the right thing to do. But they didn't finish the job. They left a tax trap in place that's going to hit millions of retirees who don't see it coming. The lump sum election and the senior bonus deduction are your way out. Use them. If you know a retired teacher, a firefighter, a police officer, anyone who worked in public service and received a Social Security lump sum payment last year, share this information with them. 13 days. That's what they have. And the difference between filing correctly and filing on autopilot could be $3,000 or more. You worked your entire career. You paid into the system. You were owed this money. Don't let the IRS take it back because of a rule you didn't know existed. Act now. File correctly. and keep what's yours. Additional context: why the IRS isn't wrong, but the system is. Here's the frustrating part. The IRS isn't breaking any rules. They're following the tax code as written. Social Security benefits are taxable in the year received. Lump sum payments are treated as income in the year they're paid. That's the law. But the law wasn't designed for a situation like this. It wasn't designed for a decades-old injustice to be corrected with a single retroactive payment. It wasn't designed to account for retirees on fixed incomes being hit with a one-time income spike that triggers cascading tax consequences. The system is technically correct, but it's also deeply unfair, and that's why you need to know your options. Because the system won't fix itself. You have to use the tools that exist, the lump sum election, the senior bonus deduction, to protect yourself. What if you've already filed and paid? If you already filed your 2025 return without using the lump sum election or claiming the senior bonus deduction, don't panic. You can fix it. You have 3 years from the filing deadline to file an amended return using Form 1040X. Here's what you do. Get a copy of your original 2025 return. Recalculate using the lump sum election, IRS Publication 915. Add the senior bonus deduction if you qualify. File Form 1040X. Attach any supporting documentation. The IRS will process the amended return and issue a refund if you overpaid. It takes time, usually 8 to 12 weeks, but it's worth it if you're owed $2,000, $3,000 or more. Don't leave that money sitting with the government. How to find help. If you're not comfortable doing this yourself, here's where to get help. AARP Tax Aid. Free tax preparation for seniors. Available nationwide. VITA. Volunteer income tax assistance. Free tax help for people who make $64,000 or less. Local CPA or enrolled agent. Look for someone who specializes in retirement tax planning. When you call, ask specifically, do you know how to calculate the lump sum election for Social Security Fairness Act payments? Are you familiar with the senior bonus deduction from the One Big Beautiful Bill? If they say yes, you're in good hands. If they say no, keep looking. The bigger picture. This situation is a perfect example of how the system works. Congress passes a law to fix an injustice. Millions of people get the money they're owed. But the tax consequences are left unaddressed. A bill is introduced to fix it. That bill sits in committee. And in the meantime, retirees are left to navigate a maze of tax rules, thresholds, and deductions that most people have never heard of. It's not fair, but it's reality. And the only way to protect yourself is to be informed. That's what this is about. Giving you the information you need, so you can make the right decisions. Before the deadline, before the penalties, before the missed opportunities, you have 13 days. Use them. File correctly, claim what's yours, and don't let the IRS take back what Congress finally gave you.